The historically spookiest month of the year, October, somehow this year ended up to be the best month in many years for the stock market. Big week next week, we'll call it Data Week. We're going to get the jobs report, the job openings report, the JOLTS, and of course the Federal Reserve. Speaking of which, we're going to find out if they're living on the same planet as us next week and if reality is in play for them. And housing, mortgage rates are obviously high, which slows down housing. But there is a huge difference between 2008 and 2022, and we'll get to that at the end of this video. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you had a great week. All right, after a terrible year for the stock market, somehow October ended up to be the best month in a very long time for the stock market, to the surprise of many. What I want to know is this. Is this another dead cat bounce? Is this a bear market rally? Or is this the actual bottom? I guess we're going to see. But there is one indicator that says to me it's not the bottom. It's the fact that 10-year Treasury yields are still at 4%. So I'm thinking what's going on with the stock market could be an extreme head fake. We will see. Another quick note. People need to stop confusing the stock market for the economy. Stock market is not the economy. The economy stands on its own. The stock market is based on access to cheap money for the TINA trade. There is no alternative. So let's not confuse the stock market with the economy on a move forward basis. And I don't think the Federal Reserve should do that either. As I mentioned, next week, Data Week, big week, jobs report, JOLTS report, which is the job openings. And of course, the Federal Reserve is going to meet. Some numbers I want to see. How many job openings there are. The last time we got this indicator, we had lost a million job openings over the course of the previous 30 days. I'm very interested to see how this job openings number looks, as that is going to play big time into the economy moving forward. And then when we do get the jobs data, I want to see if these are actual careers or jobs, and I'll define a career as the employer needs you and you need the employer. And a job being defined as something that you could be easily replaced, or you could easily replace the employer. I hope we're creating more careers. And along that line, we're going to see wage inflation. Hopefully wage inflation's in play to help people out with this rising inflation that the Federal Reserve cannot help. Moving on to the Federal Reserve themselves, we're going to find out next week if they are indeed living on the same planet as us. Hopefully. And it looks like they've already done this. They sent a trial balloon out. Hopefully they're going to take their cues from the Bank of Canada, our friends to the north. They actually slowed down the pace of their rate hikes. Just like when they sped up the pace of their rate hikes earlier this year, our Federal Reserve followed suit. So they slowed down the pace of their rate hikes. And I expect us to follow suit with the trial balloon our Federal Reserve put out and the fact that the markets have rallied since that trial balloon came out. We're going to find out if next week is a big pivot week that sets up the rest of the year. We're going to see what happens here, but next week could play to set up the rest of the year. Moving on to housing, mortgage rates still very high. Treasuries are somehow still at 4% despite the stock market rally for the last few weeks. This again is why I say this could be a head fake on the stock market. They usually say the bond guys, the treasury people, are the smartest people in the room. They don't buy it. Stock market's hook, line, and sinker on this right now, and we'll see who's ahead of the game. But I do want to make this comment. I don't know how much longer these mortgage rates can stay at this extremely elevated level without it really hurting the housing market in terms of values, or are values actually very safe because of the overall lack of inventory, which is the main difference between 2008 and 2022. The housing market is slow, but if you look at inventory charts, we had way more inventory that was needed back then, and now, simply stated, we simply don't have enough housing to support the growing population. Okay, everybody, that is my show for this week. A little shorter, a little sweeter than most. I hope you have a great weekend. Of course, if you have any mortgage-related questions, please don't hesitate to reach out to me. And again, thank you for watching as always. Have a great weekend, and please stay safe.